The IMF slashed its global growth forecast, but is it time to panic? A 0.7% cut sounds dramatic, but today we'll explain why the headlines may be missing the real story. Could today's trade tensions actually be setting the stage for a stronger economy tomorrow? Stick around until the end because we'll break down why a little short-term pain might be exactly what the US economy needs.
Moving on, thing number 3, we're talking the IMF. They slashed forecasts. Does it matter? Well, I actually just read thing number 3 with my intro segment. But Gary, thing number 3, the IMF slashed forecast. Does it matter? Let's say it twice just for emphasis.
Exactly. So, Rob, here's the interesting story on this one from my point of view. I was working with DK intern Cash and Crow this week, and he pitched this story and he said, hey, look, the IMF, the International Monetary Fund, they downgraded global GDP growth for this year to 2.8% from its original 3.5%. So, it's 0.7%. That's actually a meaningful number when we're talking about something as large as the global economy. And so we said, this is pretty interesting. What do you think? Should we put it in the 5 things? And, my first reaction was, well, who cares what these guys say? Like, nobody's accurate. Like, great, they're making projections, but who cares? Why does this even matter? And then I stopped to myself and, again, this is the correlation issue. And I said to Cashin, you know what? Let's check the data. Let's take a look and see, is the IMF accurate? And so Cashin pulled the data going back for a full decade. And it actually turns out the IMF's global growth forecasts are super accurate. They were wrong in 2 years. One was in 2018, where the actual was much better than the expected. And then they were really wrong in 2020, understandably, when, with COVID, everybody was off that year. Sure. So with the exception of 1 year where they missed and 1 year where everybody missed and, nobody was predicting, the economy to stop, they've nailed it. Every other year, I mean, these guys are within a fraction of a percent. And in some years, the dots actually overlap. So, what I can tell you is if the IMF is saying we're taking down global growth predictions, that is really hard to say. It's probably something to be taken seriously. And there's no doubt about why. They're very concerned about tariffs, and they're worried that, President Trump's tariffs will bring global trade to a slowdown or a halt. Now, again, the White House is in negotiations right now with at least 70 different countries, and they're claiming they'll have deals done soon. But, until it's done, it's not done. And the real question is going to remain, what's going to happen between the 2 largest economies in the world, how much trade is going to take place between the US and China. And, even over the weekend, nobody could decide, nobody could agree on whether they were talking or not. The US was claiming we're talking to China. China's claiming, no, we're not in discussion. So, the IMF may be right or wrong on this one, but it's pretty easy to see where they're coming up with their numbers. And I actually find their analysis to be credible here.
Yeah, a lot of cat and mouse going on, obviously, with everything with the tariff situation, Gary. With that being said, I mean, even with their forecast, not a huge decrease in expected growth either way. So again, I mean, yeah, how big of a deal? How much do we put into this, or what do we make of it in terms of its magnitude?
So, look, for the whole world, it's easy to say, hey, it's less than 1%. How much does it matter? But, again, against the world economy, it adds up to a lot of dollars or a lot of yen or a lot of won. It's the world cares about this stuff. Looking domestically, President Trump is using these tariffs in an effort to reverse years, decades of import dependence. And, the IMF and US economists are correctly saying, hey, we're worried that this dependency might hurt growth in the short run. And so, while I find that prediction to be credible, here's my question for everybody else. The US has been selling off its manufacturing capacity and outsourcing more and more to cheap overseas markets for approximately 50 years. It's been half a century. So if we want to reverse 5 decades of selling off our manufacturing capacity, I think we have to understand that we're going to take some pain up front. It's going to be uncomfortable. President Trump, to his credit, has been forthcoming about that. On this issue, he's been a little different from most politicians. Most politicians will tell you, yeah, we're going to give you guns and butter and candy and everything you want. And don't worry, nothing costs anything. It's all free, right? That's sort of what all politicians will say. To his credit, President Trump has said, yeah, look, the market is going to take a hit. There's going to be some pain. In the meantime, we'll get through it. And I think that's a really good take. And I think it is going to be uncomfortable, and reversing half a century of these outflows of outsourcing all of our manufacturing. Of course that's going to hurt, but it either we do something about it, either we take that pain, or we just become a country that exports financial services in dollars. And that's probably not a good place for the country to be. At least it's not a good place for most of the country to be, right? Like, that'll work for me, right? I can make that work, but most of the country is not, living in the New York area, focused on finance. And so if we want an economy that's going to work for, more than 300 million people, we're going to have to do something about it.
Yeah, great stuff. I call it, in my line of business, actually correlating it there with the correlation issue, the slingshot effect, right? So, and what I mean by that, slingshot, right? You got to go back before you go forward. And so a lot of times when we're working with clients and we're coming in and we're adjusting certain things that have been set in a certain way for so long, you actually early on starts to see a decline in performance, but you're reshuffling the deck to actually allow you to propel forward. A lot of different terms for it, hockey stick, whatever you want to call it, right? But yeah, I think that's
Rob,
a lot of what we're seeing here too.
There's also a question over how bad it will really be. So everybody's saying, "Oh, tariff is a tax; it's going to lead to disaster." I was speaking at a conference last week, discussing ideas. I was one of 4 speakers there, and people they give this. Well, of course, this is the worst trade policy of all time. Of course, this is idiotic, and the question is, will it really happen? And, in last week's 5 Things, we talked about this great article that Anthony Pompliano wrote. Again, he went to look at the data. He looked at previous situations where the U.S. instituted tariffs, and then there was an increase in domestic supply. Right. And in most of these situations, the price index didn't change all that much. And so, everybody's doing this. Well, of course, this is a disaster, but when people look at the data, it's not, of course. We may be taking some short-term pain, but these markets tend to find equilibrium much faster than people expect. And the correlations that people expect to see, as we talked about earlier in this episode, in thing 1 and thing 2, that's not always what people think it is, right? You have to look at the data, and the data doesn't always support that.